Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Panayiotou, certified financial planning professional, the Cap in Capitalize. And on today's episode, I had a chance to interview one of the top alternative wizards in our industry, Tony Davidow. But before we get into the topics of what we discussed in this interview, the free tip of the week, which is pertinent to the episode. Make sure that you are not investing or planning based on what other people's mouths are telling you. Make sure that you invest and plan on what your eyes are seeing. I see this all the time, whether it's everyday investors or even people in my industry. They will go and say that they are investing or trying this specific strategy out. And when you whittle it down, it's because of hearsay. Now, there's nothing wrong with mirroring or learning from those that are successful. However, purely copying them verbatim will probably lead to a long-term detriment to your overall situation. Which brings me to the topic of interviewing Tony Davidow. Tony's been in the industry for many, many years. He came out with the book, Private Markets. He sent it to me. Of course, I read it. I had to have him on the show. And we talked in depth about a number of strategies, in particular, the alternative space, which for those of you that are new to the show, alternative investments are commonly referred to as non-traditional assets. So not stocks, not bonds. We're talking real estate, private equity. We're talking about private credit, which is lending, limited partnerships, things of that nature, and how that can help you potentially within your financial plan. And just to give you a little teaser, I pushed back on a couple of Tony's tidbits within his book, because I think there's this huge disconnect between institutional mindsets, so endowments and pensions and super, super high net worth individuals and family offices, and everyday retail investors. And just to give you a little bit of a spoiler, I think it's the everyday investor that's meaning you, that's going to win in the long run. But we had an amazing conversation, and Tony's actually become a really good friend after all of this. And so with all of that, I'm going to stop talking so you can sit back, relax, and enjoy my interview with the legendary alternative manager, Tony Davidow. Just to give a brief synopsis, Private Markets, the book, and don't look that up on the dark web. You might get some inappropriate results there. But Private Markets really talks about the alternative ways of putting your money to work, which I love. And Tony, you and I have spoken in the past, and I am definitely no stranger to alternatives. And I thought about starting this episode because there were so many different ways I could have teed this thing up. And so what I want to do is I want to ease into it, because I know you're a little sensitive and I don't want you to get intimidated. And then we'll ramp it up as the show goes on. So I want to start with a 50,000 foot view. Now, I'm going to paint a broad brush for alternative investments, because really there's three popular ones in no order: private equity, private credit, and real estate. You could throw venture capital into private equity as well. We'll get into infrastructure later on, but those have been for years the big three. Now, I can't stand generalizations. It's one of my least favorite things, right behind cats in administrative tasks. But I'm going to make this generalization question. I'm going to tee it up for you, and then you're going to answer it. On average, out of the three, where would you say that you are seeing the most value?
Yeah, I think that's a little bit of a hard question, just because, again, we think they all have value, but they have different sort of values. So Chris, maybe, I know we wanted to kind of go slow as we ease into this. Maybe we should start with the beginning, which is, I think the term alternative investments is used a little too freely to describe anything that doesn't fit neatly into a box. So when I think about alternatives, I typically think of hedge fund type strategies and private markets. I don't throw everything that doesn't fit into the box in there and assume the same sort of outcome. But if I think about private markets, and I think you've identified kind of the big three, private equity, private credit, private real estate, I'd argue they're different and diverse tools, right? Because private equity is primarily added to the portfolio because historically it's delivered that excess return. So it's really more of a growth driver in your portfolio. Real estate and private credit can both provide a little bit of growth and income. But I think in particular, their interest in this environment has the alternative source of income that has been so needed over the last couple of decades. You and I have been doing this for a long time. You go back to the zero interest rate environment. People weren't getting any income in their fixed income. Private credit became the most popular. So probably across the wealth channel, most of the flows have gone into private credit. But as a father of two girls, and I know you have children as well,
Yes.
I typically don't want to favor one versus the other. I just want to recognize each one has a different role and different sort of purpose in client portfolios.
I agree with that. I 100% agree with that. If I could agree over 100%, I would, but that would require leverage, and I'm not that type of guy. But I will say, with that being said, because I've thought about this a lot, and we'll get into we'll get into like asset allocation, all this later in the episode. And by the way, listeners that are tuning in, this is going to be a much more nerdy episode than most because Tony is kind of a god in the world of alternative investments. You didn't see it before we started the episode, but I did bow when he got on the screen as a token of respect. But I asked that question because I have been curious on really two of them lately. And of course, I provide all of these things if it's appropriate, et cetera, et cetera. But we're cutting through the fluff. Historically, as you mentioned, private equity, or actually I'd go a step further, ownership in businesses are going to outperform real estate. And actually there's another really good book, and I've mentioned it many times in the past, by Adam Cecil, a friend of mine, Where the Money Is, Value Investing in the Digital Age. And he's got this beautiful chart on the average growth of a business compared to the average growth of a rental property. And I say that, though, because real estate over the last couple years has been hammered because of interest rates. Now, that doesn't mean the investments are bad. It's just the nature of the beast. And so personally, for me, I've looked at real estate as of lately, and I don't think it's right there yet. I mean, we're recording this at the end of May of 2025, but it's getting really close to having that deep, deep value where you can make an argument that real estate in business-like returns are going to be pretty synonymous because of that deep discount. And I was just curious if you had any thoughts on that regard.
Yeah, so maybe we could take a little bit of step back and think about like where we are in the cycle, because I agree with you. I think real estate does look attractive. So real estate clearly has come down since peak valuations of 2021. Part of that is rising interest rates were a headwind. There were also concerns about the office sector. So I think a little guilt by association. We'd argue real estate valuations have come down pretty substantially. We think they look attractive. We never try to call the bottom as you suggest. Right. We're not calling the bottom, but we do think that in certain areas of the market, it looks really attractive. So we think industrials look attractive, multifamily, life sciences. So there are areas that you definitely want to favor. And there are areas like offices that we think there will be a long-term challenge in the office sector. So if we're thinking about committing capital, I'd ideally want to commit capital to a manager who has the freedom to identify the really attractive opportunities and avoid those that seem really kind of frothy and expensive. So I like real estate in this environment. We have a 2025 private market outlook. We updated it in the middle of some of the trade tariff dislocations. We still continue to like real estate, but it's not all real estate sectors will perform equally. It will be select areas will do really well. And again, we think that long-term headwind will be in the office sector for the foreseeable future.
Yeah. Yeah. And you brought up a good point, because when people say, what do you think of real estate? That's a broad brush. I can make an argument that owner-occupied office space could do really, really well. If you buy a quality building, you're going to be there for 30 years. You get some bonus depreciation, all that fun stuff. But yeah, it's not looking good for our heroes in the office space department. Now, I wanted to move on a little bit to the hot topic of alternative investments, infrastructure. Infrastructure is the hot gal that everyone wants to take to the big dance right now. And infrastructure has been around forever. I mean, it's not anything new. I mean, people know what utilities are. They know, like the classic toll bridge idea. That's utilities or infrastructure 101. I have a confusing relationship with infrastructure right now, because on one hand, it's not like, and I know I'm not supposed to say this, but it's not like cryptocurrency where people just go all in and it's a truly, truly, truly speculative asset. Infrastructure has been around for years. You can look, you can see it, you can touch it, you can taste it. But I'm curious your thoughts in general with the space, because I have a similar feeling to the internet in the .com craze in '97. I don't think anyone would have denied that the internet was going to be here for a while and be here to stay, and it was valuable. But there were people like pets.com that were getting in, and they really had no business being in there. And so what's your take on infrastructure? Do you think too many people are rushing into it? Do you think it is overblown on that conservatism?
I think there's a couple things with infrastructure. One is, as you point out, infrastructure has been around for a long time, but there really hasn't been a lot of infrastructure investment in the U.S. for quite some time, up until recently, right? So a lot of the infrastructure opportunities have been more global infrastructure opportunities. And one of the things I talk about in the book, because I do think that there's a lot more interest in infrastructure today, is the growth has primarily been in areas like China and Africa and Australia, and there definitely have been global players who have benefited from that. We've been a little slow. We now have a big infrastructure bill. We haven't necessarily put shovels in the ground on that. So I think that part of the appeal of infrastructure is the expectation of where it's going to be in the future rather than where it's been in the past, because in the US it has been fairly limited. The other thing that I would point out, and it goes back to our real estate conversation as well, there's a really big difference between public infrastructure, buying a Caterpillar, which is a beneficiary of infrastructure, versus true infrastructure projects. And there are a lot of infrastructure products that are in the market that are essentially buying kind of the ancillary sort of benefits or the beneficiaries of what will happen with infrastructure, but you're not buying infrastructure projects. So infrastructure, if you're buying the pure private asset, we think is very appealing. And I do think that will be an interesting place to be for the foreseeable future, largely because we're going to have to build our bridges, tolls, airlines, cell towers, water treatment facilities. So all of these broader things, and to your point earlier, we tend to think of kind of the bridges and the tunnels, but the reality is infrastructure is such a broad category now that I do think there will be an appeal there. But I would draw the distinction between private infrastructure, which we think looks very attractive, and public infrastructure, which is essentially an equity beta play. Just like publicly traded REITs have a higher correlation to stocks than they do to private real estate.
Yeah. Well, and you brought up the point, and I'm going to say exactly what you said, but I'm going to translate it into the cap and capitalized terminology. If it walks like a stock and it talks like a stock, it's a stock. Yeah. And it is funny you mentioned Caterpillar. I actually wrote my thesis in college on Caterpillar back in the day. And this is not like investment advice. And I actually think I did a really good job. And then my professor gave me like a C. And then I realized he never actually invested or professionally managed any money. And I probably said some things I shouldn't have, which then got me to a C minus. But, you know, back to your topic of private versus public, I agree with all of that. I agree with all that immensely. My concern is it's like AI. The last couple of years, if you say, hey, our business is getting into AI, boom, up and to the right. No questions asked. Even if if the company's ran by a moron and he or she says, hey, but we're getting into AI, suddenly you have 100% rate of return for no apparent reason. I don't think you can have that type of craze with infrastructure because, frankly, it's a pretty boring asset. Like, I don't know anyone that's just fired up like Ray Lewis coming out of the tunnel of a Ravens game for infrastructure. If anyone is, I would love to have them on the show because that is another layer of spectrum that I can't grasp. But I think to myself, infrastructure can be a disguise for private equity. Because I've caught people where I'm like, oh, this is a private equity investment. This actually isn't infrastructure. And then you've got all of these asset managers that are just flooding the gates of infrastructure. And that was more of a question I had is, are you concerned that too many people are getting into the space? And by too many people getting into the space, that could result in overcrowding. And then overcrowding gives a really bad rap because most people should not be in it in the first place.
Yeah, again, I think we're early in infrastructure opportunities here in the U.S. I think a lot of people are definitely excited about it and talking about it. Again, I'll draw the distinction. Private infrastructure, there's not a lot of really great private infrastructure investments out there. I think you're right in the sense that sometimes we have a tendency to go to the bright, shiny object, whether it's AI or you mentioned the dot-com bubble, both of which I lived through. And I remember a lot of those opportunities. First of all, I tend to look at everything as a long-term investment. So the reason I like private equity, private credit, private real estate, or infrastructure for that reason is I'm actually thinking about the opportunity over the next 10 years. So I'm not focused on the bright, shiny object as much as what are the investment merits of it? Does it play out? And then ultimately, if I add it to my portfolio, what do I expect to happen? And I think there's a case to be made that on a long run basis, infrastructure looks attractive because we're going to have to invest in our, I don't live there anymore, but I lived for a very long time in New York City. So if anyone's in the New York City area, you'll appreciate how much work needs to be done on your roads, your tunnels, your bridges. And it seems like anytime you start a project, it will take years and years and years. And by the time you finish, you're ready to redo it again. So I believe there's a long-term opportunity there. On the short run basis, are there people who will try to take opportunities and mislabel things to catch the assets? Of course, I think that tends to happen. The other point you made, I think, is an important one, which is there's this fuzziness in some of the terminology. Infrastructure could be debt, right? So you need debt financing for this. You sometimes get this blurring of the lines, and one of the areas that we're the most excited about is real estate debt. Right, real estate debt is typically funded by private credit managers who are actually lending capital. But commercial real estate debt could also be thought of as part of real estate as an asset class, right? So you can own the equity component, or you can own the debt. So there's always a little fuzziness there. And I just like to understand, ultimately, what is the underlying assets I'm getting exposure to, and what does it do when I add it to a client portfolio? But I think there's a lot of long-term opportunities. I know you wanted to get into it. I think there's some shifting sort of dynamics with some of the environments that we're experiencing. We went through an environment in 21 where everything was kind of peak valuation. We started to see a little bit of a give back in 22 when stocks and bonds were both down double digits. And all of a sudden people woke up and said, well, maybe I need a more diversified portfolio. 23, 24, the equity markets actually did exceedingly well, even though there was a lot of risk out there. And as we sit here today at the end of May, there's a lot of volatility. There's a lot of unknowns, and you and I have had discussions about it. I don't know that any of us have a great crystal ball because some of what we're experiencing is uncharted territory. So to me, I always think about the long-term opportunity, and then on the short run, you can make these tactical shifts where appropriate. We're not suggesting tactical shifts when you think about private markets because they're long-term in nature. But if I'm sitting on cash today, where do I think the best opportunities are? Where am I thinking about deploying capital? And I like managers in this environment who have the freedom to see the opportunities as opposed to buying something where you're buying kind of market exposure. And the reality is, I think the market opportunities over the next 10 to 20 years are really exciting in the private markets. but I want to give that manager the freedom to find them.
Yeah. I could argue they're exciting, period. But, maybe I'm just too optimistic. I know our first conversation, you're like, Chris, you got to tone it down on the positivity, which I've worked at it. I wore a more conservative shirt for you today. I was going to wear something
don't
more
tone
fun.
it down. Don't turn it.
Okay.
Keep it up.
All right. I was just, I want to make sure. Now, I actually do want to take it up a little notch here. And you mentioned having, and this is where we align very much in the fact that your timeline is forever. It's long term. It's perpetual, et cetera. So let's assume that you, as in Tony, are working with someone looking to rev the engine and grow their money. So from a growth standpoint. And we're also assuming their time horizon is the same as yours and mine, long term. How would you approach their allocation?
Yeah, I think, the typical, maybe I'll start with the typical sort of way that we would think about it. If we're, first of all, you're of a different generation. So for you, I would say your time horizon is much longer than mine. But I hope, I think that my time horizon is long. So that's the good thing. So let's just assume you have a 20-year time horizon. Mm-hmm. I think depending on what your cash flow needs are. So I think mathematically, if you looked at all of the data in an unconstrained fashion, you would have very high exposures to areas like private equity and private credit, right? Because I'm going to get higher returns there. And if you're willing to tie up your capital for an extended period of time, I know I'm going to be rewarded for it. The one thing I would think about for you, for me, or for the folks on the phone is, do you have liquidity needs? So I'm a long-term investor and I'm willing to commit my capital. I want as much private equity as I can in my portfolio. And I might, like a Harvard or Yale, I may in fact overweight my private exposure relative to public market exposure. Mm-hmm. But if I'm an individual investor and I know that although I have a long time horizon, I may need my cash somewhere along the way. You have a young child, you may think I have to send my child to school, or I'm thinking about retirement. So I almost think about you back into it, because if you just left any of these models in an unconstrained fashion, you would take as much private equity, private credit, private real estate as you could because of the favorable risk-adjusted returns that you get. But if you think about it more from a cash flow perspective, which I know you do as a planner, you almost kind of back into it. If you think about what are your cash flow needs over the next 10 years, what sort of liquidity needs may you need on a short run basis and a long run basis, then I can actually model what's the right and appropriate percentage. Sure. But left unconstrained, those would be very large numbers.
Yeah. Well,
and I'm not uncomfortable with a 20-30% allocation to private markets. I'm not suggesting everyone should be, but for me, that doesn't bother me at all because I know my time horizon. At my stage of life, I really have very little income needs. And I'm comfortable that there may be some volatility along the way, but at the end of the day, I know I'm going to be rewarded handsomely for investing for the long run. And I tend to think of that as patient capital.
Well, you're a patient guy, Tony. So that makes a lot of sense.
I have to be.
Yeah. Well, so the reason why I was asking, so this is kind of my take on if let's say that you're growing your net worth, and obviously it depends on the client's needs. We get all of that. To the compliance people that are going to be watching this episode, you know that I know this, so just like don't scrub me on it. So let's assume that you are talking to someone in their 20s, 30s, 40s, because you could argue that time horizon it's still the same. And and going a step further, they do not need any money from their portfolio. They're trying to grow it. So one of my New Year's resolutions, I don't know if I told you this, is to read every Berkshire Hathaway annual shareholder letter. And I've got 10 years left. I've read up to 2015, and it's been a journey. And it's interesting because a lot of people actually don't understand that Warren is not just a public markets guy. And it's ironic because he always bashes private markets because you guys get paid so well, right? And you don't deserve that. Wink, wink, nudge, nudge. But he owned and owns a boatload of privately owned businesses within Berkshire Hathaway. So there's this combination of private and public. And so when I started researching the endowment model back in 2016, when I had really no life, I started to discover the value of, oh, this isn't an either or, it's an and. And you mentioned that. So I'm in talks actually of speaking with reading between the lines, a local pro football team in my area. And a lot of these guys ask similar questions, athletes ask, like, what is the best strategy to grow one's net worth? Now, if you just don't get it and you want to keep things really simple, you're probably going to stick to the market because you need some liquidity. I get it, because liquidity is valuable. Stock portfolio, ETF, mutual fund, don't really matter. The flavor doesn't matter. You're all in Baskin and Robbins, meaning the market. So if you want to take it up a notch, though, like what I like to look at is a combo of a concentrated stock portfolio and then private equity, maybe a little venture. And then what I like to do is I like to bunch the capital gains that come off. Let's say a stock gets acquired or you sell it for a gain, or these private equity funds or holdings have a capital gain. And the last couple of years, what I've done is laddered opportunity zones because of the tax strategy. And then what's really cool about that is as you get to that point where obviously the taxes are owed, they've got the cash flow to pay it, or the op zones actually do their thing. But then when you get to retirement, that's where you start to liquidate and ladder a lot of those private equity holdings, because a lot of those reinvest basically as much as they can into the business, which again, like a share buyback, you would much rather reinvest versus get paid a dividend from a tax standpoint. So you get to retirement, start laddering and liquidating those private holdings, maybe public if the market gives you a premature future return. A little biblical there. And so you take that gain of the private equity, and you could even opportunity zone those, assuming those are still in existence by the time we get there. But then you take that principal and then you'd start converting it into real estate or private credit, because at that point, the bummer with private credit is you are paid ordinary income tax. Not the best. So It's one of those things when you retire in a much lower tax bracket, et cetera, et cetera. And then you can obviously shift and allocate. And you read my book. And so to lifetime income strategies, structured products, whatever the case may be. But that's where, like for you, you're also saying on a more broad standpoint, I wouldn't necessarily get that nitty gritty into the weeds. You would almost just open it up to, hey, I would have some type of private exposure. And then from a behavioral standpoint, when you're chatting with someone, that's where you would allocate accordingly. Was that kind of where you were going? And you can critique me, by the way. I won't get offended.
Yeah. So there's a lot to unpack there. And maybe if I can, I'll kind of start with some of the, so you mentioned the endowment model. And of course, the endowment model became famous when David Swensen, the former CIO of Yale, really turned investing upside down. So I'm a big fan of Warren Buffett, but I would say the most influential investor of our lifetime, without a doubt, is David Swensen. David Swensen has really pioneered portfolio management, really taught us to think differently about it. I'm definitely a disciple of his. And during much of his tenure, he had a 70 to 80% allocation to alternatives and a very small allocation to public equity. And part of his rationale was that's where he saw the value. And he actually talks about the illiquid natures where the inefficiency of the market actually yields to higher results over the long run. Now, I'm not suggesting that individual investors should have 70 to 80% allocated to alternative investments and a 50% illiquidity bucket, which is the way that they typically manage. But at least it's instructive to say those with the freedom and the access to these once elusive investments made very, very big bets. Another sort of vantage point that I often cite in my research is I look at the UBS Global Family Office report. Maybe that's a little bit more relatable to people. There, the average global family office has a roughly 42% allocation to alternatives, 22% to private equity. Again, that being the largest component of it, partly because you think you're allocating capital for multi-generation, so you've got a long time horizon. So again, a group of investors who have had access to it are making very, very big bets. Chris, you and I had this discussion in our warm-up call, and that is that in the wealth channel, that number has roughly been 5 to 6%. So I'm not suggesting you go from 5% to 40% in one fell swoop, but if you can go from 5% to 10% to 20%, the reason it makes sense is you increase the likelihood of achieving your client's goals. Again, assuming they have the time horizon and assuming you get access to the best managers, you're going to do better over the long run. And I think that's why this is such an exciting opportunity in the Wealth Channel, because we couldn't access these great managers 10 years ago. Now we're starting to access, and we have products that are more conducive to the way that high net worth investors allocate capital. They're available at lower minimums, lower thresholds. They tend to be evergreen in nature, which means I get the full exposure to the asset class rather than having to buy it through a drawdown structure. So to me, it's an exciting time, but I don't think that we go from 5 to 40 in one fell swoop. I think we get there incrementally, and is largely doing what you're doing and what I'm doing, which is getting people comfortable with the asset class, doing the math on it, and then incrementally adding it. And again, I think if you do the math on it, looking at a 10 to 20% allocation, you start to dramatically change the overall composition of the client portfolio. You start to change the risk, the return, and it's largely because these investments are not correlated. Low diversification. I know we wanted to kind of speak in plain speak, but lower diversification relative to the overall market. So when we get the market shocks, we're not taking the brunt of that. So I think over the long run, we're going to get there. But I think it's got to be something where we work in conjunction with investors so they understand it. You're doing a great job trying to break this down into plain speak for your audience so they understand it. I hope that they get more comfortable. As they get more comfortable, they have a better experience. They're going to be more and more comfortable in increasing their allocation over the long run.
Sure. And I love that. I loved that, man. I don't know about you. I'm having fun right now. And by the way, it's going to get more fun. So brace yourself. I have a little bone to pick with asset allocation. So on the surface, asset allocation is immensely valuable because you need to start somewhere. You got to start somewhere. I don't care what the allocation is, you got to figure it out. That being said, once it starts, it meaning the portfolio, the relationship, whatever you want to call it, things change. I don't know if you knew that, Tony. Things change over time. So
I've seen changes for 40 years.
Yeah. And, with asset allocation, that's where my issues are. So the nature of asset allocation, especially with like these institutions, and there's so much bureaucracy that goes into it, where it's kind of fixed. It can be clunky. It can be automated, even in the retail space with everyday investors. Second, the automation and the fixed aspect of an asset allocation, meaning for my listeners, you have to have 30% in stocks as an example, or 40% in bonds, whatever the case may be. You're naturally going to restrict yourself to missing out on an immense amount of opportunity because of those restrictions. And then third, the process of reallocating to a proper asset allocation, especially for taxable accounts, incurs unnecessary taxes owed and transaction costs in the process. So what is your take on asset allocation? And if we need to have a debate about it, we can. And I promise I will play nice.
Capitalizers, this episode is sponsored by the best-selling book, Capitalize Your Finances, the how-to framework that takes you from compoundingly clueless to monetarily magnificent. Regardless of where you're at in your financial life, whether you're just beginning to express interest and commitment to your personal finances, at the pinnacle of your career, winding down into retirement, or thinking about your legacy for future generations, this book walks you through every step of the way so you can succeed on your terms and with your own values and passions guiding you. After reading this book, you will officially have Christopher A. Panayotou, the Cap in Capitalize, in your back pocket, guiding you in detail through every step of the way so that you can take charge of your finances, not the other way around. Head on over to Amazon.com today and start capitalizing your finances to the fullest with this incredible book, Capitalize Your Finances, the how-to financial framework that takes you from compoundingly clueless to monetarily magnificent. And now, back to the episode.
So here's what I would say. It depends what you mean by asset allocation. I think, again, if we go back to the beginning, and I had the opportunity to spend a fair amount of time with Harry Markowitz. I served on an advisory board with him. Harry Markowitz came up with modern portfolio theory and really introduced diversification. I think that's immensely valuable, but I don't think it's the end all be all. And I think some of the things that you picked up are some of the things that I remember challenging him and highlighting with him that, what if you're an individual with a large concentrated position? A mean variance optimization model isn't going to give you the right outcome for you because it might suggest you sell your large concentrated position because it's too risky. But for personal reasons or restrictions because you're the CEO or a senior executive, you can't sell them. So there definitely are limitations in it. And there are definitely limitations if you're so rigid and you're forcing yourself to rebalance back. What I would say is I do think it's good to have a long-term strategic allocation and a target. I think some people believe you should be more tactical around the margins, and I see value of being more tactical and nimble if you're able to see the future. I recognize the limitations in just looking at historical data, and I know some people believe you should be using capital market expectations or capital market assumptions, whichever one you want to call it. But that introduces another layer of difficulty, which is, can you accurately predict where the future returns are going to be, which I think is very difficult to do. So there are a lot of different views around it, and I think it's a good thing to challenge the basic premise of asset allocation. But I think if we strip it down, I suspect that you and I are still 100% aligned that diversification makes sense. Have a long-term plan makes sense. Being nimble when it makes sense to be nimble makes sense. But being disciplined when it really is important to stay the course also makes sense. So whatever we call that our basic, philosophy for investing. I think that makes sense. I think to your point about being too dogmatic and too rigid and maybe relying too much upon the past to give guidance on the future, that can be challenging, and there are definitely limitations in that. There's one additional sort of element to this, and our friends at Kaya recently came out with a paper on it looking at total portfolio approach. And Chris, if you think this is interesting, I could introduce you to some of those folks. Maybe that'd be a topic for a future discussion. And TPA, as it's referred to, is something that's used by institutions, and they are less rigid and dogmatic in their approach, and they actually have greater freedom, which is easy to do if you've got deep and dedicated resources that can say, for my incremental next dollar coming into the portfolio, I'm not looking at my asset allocation parameters. I'm actually saying, where is the best opportunity to allocate capital today? But it requires a different sort of framework and a different sort of governance body. I actually interviewed Aaron Philback on that topic for one of my podcasts, and I thought it was very well received. We talk about how institutions do it and then some of the inherent challenges for individual investors. But I think the reality is there's nothing wrong with challenging any of this stuff. And I think for my 40-year career, I've always challenged conventional wisdom. Sometimes I've been right, sometimes I've been wrong. But by challenging, it kind of teases out what's right about something and what's wrong about something. And I think what you've identified are some of the limitations with asset allocation.
Yeah. And you didn't strike the nerve, but you struck a nerve with me there in the fact that you reiterated one of my largest frustrations with the industry. And I'm talking the financial advising and planning industry, because I'll just say it. Most people in my side of the aisle are very lazy. Like, newsflash, most planners don't even write their own plans. I'll give you a story. My amazing teammate, Betty, was out to lunch or dinner with a group of her friends. And before she came and worked for me, she was on like the institutional side of Russell Investments. So like, she's been in the world of finance for years. Mm-hmm. Okay. Different beast, but same thing. And so she has friends in the industry, and she's talking to them and asking, okay, well, like, what does your planner do? Blah, blah, blah. And we get lunch quarterly just to check in, like, hey, you still hate me? Am I doing a good job as a boss? Things of that nature. Gossip about people, the standard stuff. And she goes, I gotta ask you something. And she asked me everything. Like, so this friend of hers, who's a planner, I don't even think a planner, advisor, meets with people, gathers the information, shoots it off to some dude in a green room. The dude in the green room gives the friend the plan, and then the plan is presented to a client. And then once that's done, there's another person that that's not planning. That is not planning. That is like glorified wholesaling of something in the wrapper of advising. So that in of itself is like very, very wrong. But then you get into, if you actually look at statements and every quarter, you got to rebalance and allocate to X, Y, and Z, especially with someone with like a long-term time horizon. Retirement, it gets a little bit different, but there's still a ton of issues with that. Long-term, you are missing out on a boatload of opportunity. And I'm not even guaranteeing it. I'm just, and this is more for compliance people so they don't shoot me in the throat. I'm just being real. So go back the last 5 years. 2020, did public markets have a really good year? Oddly, yeah, they did. Now, where was the deep value? Now, maybe March and April when COVID graced our shores, that's where the public market value was. But that went away in what, a day? I mean, it was gone. And then you started looking going, all right, well, if the Fed says, hey, we've got to raise interest rates, and then the next quarter they go, hey, by the way, that's still going to happen. And then the quarter after that, they go, okay, now we're really going to raise interest rates. Private credit's probably going to look pretty good, assuming you have floating rate loans and all that. So you could have made the argument in 2021 that you could have been allocating more to private credit, all things being equal. 2022, what happens? Market takes a dump. Suddenly now you're looking at public markets because it's more attractive. Buying the dip, as they say. 2023, private markets were maybe looking a little bit more attractive because it was pretty hard to find deep value in these other areas. 2024, same thing. And then lo and behold, the year of our Lord and Savior, 2025, crap hits the fan. Suddenly public markets are back on the menu. It's a great little quote, shout out from Lord of the Rings. And then real estate, because it's been kicked in a body part of your choice for the last couple of years, suddenly it has deep value. So if you're growing your money, you should be thinking about these things and throwing money strategically if you have conviction and all that. But my point is asset allocation completely restricts that for people. And unfortunately, most people are really lazy with it. So that's my vent on asset allocation. I will pay whatever bill you send me, Tony, for the counseling that you are giving me. Now, how do you think asset allocation could be improved?
Yeah, so again, I think the basic tenets of what we are talking about, diversification makes sense, having a long-term plan. So in my first book, I actually, similar to you, pointed out some of the limitations in modern portfolio theory and asset allocation. And then we understand these behavioral sort of elements. And one of the things that I suggested in my first book, which was called Goals-Based Investing, was that's a way of marrying the attributes, right? It's marrying the long-term merits of allocating capital, understanding some of these behavioral sort of elements so we're not so dogmatic about it. And goals-based investing allowed us to align around what are we solving for clients. By the way, it should align very well with the way that you think about planning rather than fixate. And I suspect there's some folks on this call who are, like it or not, they look at the market as the barometer and may view you and your peers as your barometer is beating the market, where I would argue that's not at all your value. Your value is increasing the likelihood of achieving your goals over the long run. So I've argued that goals-based investing is a more evolved sort of way of allocating capital. It has tenets and elements of modern portfolio theory, kind of the first sort of view of this. It incorporates aspects of behavioral finance and some of the limitations and the emotional stimuli that we respond to. But ultimately, I think it aligns us around achieving client goals as opposed to fixating on, did I outperform the market in a rising bull market? Or, gee, I would have been better off sitting on cash in the middle of 2022 when the market was down. So again, that's harder to do than, the easy button, hitting the easy button on your portfolio and then just spitting something out. But over the long run, I think it's good for advisors and it's good for investors.
Yeah. I'm all about the simple button. I do have that, and I love that button. But the easy button in my office, it's really when you're able to afford to fly on up, I'll show you. It's rusty, it's archaic, it's crusting. Like I haven't touched the easy button in years. So hopefully that gives you some positive light to take throughout the rest of your day. Now, you mentioned in your book the concept of total portfolio approach. So just briefly discuss what that is and describe it to my guests, because it's interesting to me.
Yeah, and it's what I referred to earlier. It's maybe the evolution of modern portfolio theory and goals-based investing. And similar to goals-based investing, it's really designed to align around what are we solving for and what allows us to achieve that over the long run. Now, again, it's something that I think institutions have begun to embrace. So some of the largest institutions have, but it's not necessarily embraced uniformly, and it's not necessarily applied the same sort of way. But essentially what it really gets to is having a governance structure that provides the freedom either to an investment committee or a CIO to make the smartest allocation of capital, right? And we know that that's easier said than done, because the temptation is, again, being dogmatic about it or being emotional. Things feel really risky here now, and therefore I want to pull risk out of the portfolio. Well, maybe the smartest thing to do is actually to say, I should be allocating more to private equity or to secondaries, because I think that's where the best opportunity is. So there's kind of pillars of that where you want to focus on, do you have the right governance structure? Do you have the right team in place? And then there's the competition for capital, which is the element that I think is the most exciting and probably the one that's most tangible for people to take away, which is rather than being dogmatic and saying, I'm over allocated to my private equity now and I'm really forced to trim that position. Maybe actually now's the time I should be increasing the position. So rather than being mandated by your investment policy statement, you need to have the freedom to say that competition of capital says that my most efficient use of that new dollar coming in the door is to increase my allocation. Again, easier said than done, but I think that's something that institutions have began to embrace. I think that could be where, Chris, you and others start to take your practice, because it seems like that's really the way that you're thinking of the world, is you don't want to be so dogmatic. You want to have that freedom. You want to really be looking forward and thinking about where's that best opportunity to allocate tomorrow and the next day, as opposed to driving in the rearview mirror. So I think TPA is definitely something that we all should be paying attention to. I suspect it's going to be a gradual journey to get there. It's not all of a sudden you completely turn your process upside down. But at least for that competition of capital, I think if you start to instill that in your team as you think about it, you start to think differently about allocating capital going forward rather than driving in the rearview mirror.
And it's interesting you mention, and we'll talk about like that in a little bit toward the end of the episode, the dynamicism. You've mentioned dynamicism and nimblism a lot. Which I'm not a tattoo guy, but if I was, those would probably be my first tattoos. Probably conservatively on each shoulder, just so I can, conserve
hide
them
from
the
everyone.
world. I thought about my forehead because I got a lot of real estate up here, but I don't know how well that would go over with people. Now, I wanted to ask a personal question for you. And it's not like the Will Ferrell and Step Brothers. How much do you make before taxes? But how do you plan for yourself? And like, what does your plan look like? Not giving specific investment advice, again, compliance people. I'm just curious because we've joked about it a lot, but you are a man of success in our industry. And a lot of people look up to you. Like I said, I bowed when you got on the camera. So I think it'd be valuable for our listeners to know what one of the most successful people in our industry actually does for his family.
Well, thank you for that. And I'm not sure I'm worthy, but I'll take it for now. I would say, it's kind of an interesting question too, because when I started in the industry, Chris, and of course we're a different generation, but when I started in the industry, you were told as you got older, you should be more conservative with your investments. And you kind of touched on it earlier, and I think you and I might have talked about it in one of our calls. I'm actually a believer, that when I started in the industry, your goal was you got to retirement and essentially, you retired at 65 and you died at 72, and that was fine. Now you need to model what is your life like through retirement. So, my wife and I were just having this discussion yesterday. I'm thinking about what am I going to do for the next 20 years, the next 30 years. So my time horizon is long. So I actually have a healthy allocation to private equity. I actually own private equity secondaries. I own private real estate. So I'm definitely thinking long term because I know in the long term I'll be rewarded for those assets. So unlike people of my generation when we started in the industry, I didn't drink the Kool-Aid and just assume by the time I got to my age I'd be, clipping coupons and sitting on a beach. I want to live a long, productive life, and I want to make sure that my money lasts as long as I do. So my allocation is probably aggressive for a lot of people of my generation, but it feels right to me. And it feels right to me because, one, I understand the risk that I'm taking, and I understand what I want to do over the next 20 years.
Don't you find the aggressive conservative conversation funny? Like that's actually one of my biggest issues with this industry. Like people come in and they go, I'm conservative. Or I'm aggressive with investing. I go, well, what does that mean? They go, I don't know. Like I don't know. Like it's
normally you're aggressive in a bull market and you're conservative in a bear market. So you're a little bit of a behavioral sort of bias away from where you really are. And I joke a lot that, when I used to sit down with clients, I almost heard every client say, I'm an aggressive client with a long-term horizon. And then all of a sudden you get a bump of the road and they're like, but I really meant like a day, like a quarter. A quarter is long-term for me, right? So it's funny. I agree with you. I think those terminology and those labels don't really work. And I also recognize that people fall into the trap because they believe they should be an aggressive investor, which means they get an allocation to equities, right? Because you don't want to sit on the sidelines and miss out. But then when they are exposed to the market and there's bumps in the road, they're thinking, no, I really didn't mean that. I want to be sitting on the sidelines until things get better. And of course, we know that they miss the opportunity. They get into the market too late. So you miss both sides of that.
And even with that, so have you read Nick Murray's work?
Sure.
Yeah, Nick's great. I've never had him on the show. I'd love to have him on the show. And he's been doing this forever. And
he's older than I am.
Yeah. Well, yeah. I mean, I was going to be a gentleman and not mention your age, but you did it. So it's one of those things where, as I've read, whether it's Nick Murray, your book, Dave Rubenstein, How to Invest, another winner, obviously all of Berkshire shareholder letters. It's the more I've read over the years, and this really clicked for me in, I'd say, 2021, 2022, where I've recognized it's not people's fault that come into my office in clients when they go, I'm aggressive, I'm conservative, because they have no idea. Actually, right. No one knows from outside the industry. I'm probably going to rustle a lot of feathers by saying this, but shame on my industry as a whole for being so piss poor at enlightening people on what risk actually is. I was talking to one of my buddies about this when we were at dinner a couple weeks ago, and I was venting to him because that's what friends do. And also we're both young dads, so we're just tired and complaining. I mean, that's what life is, right? And I told him, because he's also really fascinated about just my industry, and he's not in the industry at all. And so he said, what's your biggest frustration? I'm like, oh my gosh. And I started telling him about how people our age, let's say that you walk into someone's office, someone's financial planning office, and you're an everyday person, and you go, I'm a conservative investor. Okay, so what does that mean? You're pretty much restricted to a little bit of equity exposure, but then everything else, CDs, money markets, bonds, and from an emotional unintelligence with money, congratulations, you're investing according to how you feel. Whoop-de-freaking-do. Your plan as a 30-year-old just got immensely more aggressive because now you have to find out how in God's name you're going to get to 60 to have that pile of money to make sure that your standard of living in retirement for the next 30 or at that point 40 years, because people are living longer, are going to make it. So if you reframe it to knowing statistically what the odds are that these different vehicles, publicly traded, private markets, doesn't matter, are earning in the long run statistically, and you understand, again, past performance doesn't guarantee future results, but it can be a wonderful indicator of where you should probably look to earn some type of return. You don't necessarily have to save as much because your money is working better for you. Therefore, your plan is more conservative, but you're actually investing traditionally more aggressive. And that is one of the biggest things that pisses me off about this industry. I can't stand it, man. And by the way, if you need to send me a bill, again, for all the therapy that you're getting out of me, I will pay it. I'll probably finance it like DoorDash and Costco is doing now. But jokes aside, it just, it's irritating. And that actually brings up another point I wanted to ask you. Where do you see financial advising and financial planning going in the next 5 to 10 years?
Yeah, so I've been doing this for a long time and I've seen a lot of evolution. It's again, it's tough to generalize. I think that the better advisors like you have figured out the language and the way to present this. And, I think like you, I cringe a little bit at our industry jargon. It's easy to fall into the jargon. It makes some people feel smart, but it also can be intimidating to clients. So I live in a fairly complex world with a lot of complex terminology. I go to great lengths to simplify it. So I hope people understand what we're talking about, right? The private markets can feel very mysterious unless you simplify, remove the jargon, and make it relatable. At the end of the day, I want everyone to understand what they're doing. I don't want them to make a decision because everyone else is doing it, and therefore I must be, if I'm of a certain wealth level, I should be having exposure to private equity and venture capital. So again, I agree. Let's minimize the jargon. Let's really focus on outcomes and ultimately make sure that individual investors understand what they're getting in for and understand the rationale for it. And I forgot your question.
Well, I was just saying, and you kind of answered it. Financial advising and planning.
Where we're going as an industry. Yeah, so I think it's interesting as an industry. I think, again, I kind of started where, advisors more transactional, and then everyone wanted to become a consultant and focus more on planning and thinking about outcomes. And as much as I think that there are certain aspects of this industry that can become commoditized, right? Technology can do a lot of things. I think good quality advice never goes out of style. And good quality advice is more than just the math. The math is the easy part. The math is the crutch for all of us because it helps tell the story we want to tell. It's understanding some of the behavioral sort of things and understanding that client's temptation is to do the wrong thing for the wrong reason at the wrong time. So I think quality advice never goes out of flavor. And I would say that as we anticipate what the future looks like, the future is going to get more complicated, like it or not. We're going to have more change. I think if I look at my world, private markets, again, are relatively new to the wealth channel. They're not relatively new to the institutional and the private market, the global family office space. Those are big allocations. These are becoming bigger and larger components within individual practices. We're going to start to see a further definition of private equity. You mentioned private equity and I've mentioned secondaries and venture capital, but we're going to start to see that slices of the pie get more finite over time. Private credit, we're going to start to think about more than just private credit, which is kind of a big descriptor, and maybe have more discrete allocations to direct lending, asset-based finance, commercial real estate debt. So we're going to make things a little bit more complicated before they get easier. So I think the advisor, you're at the tip of the spear. Your value is helping to simplify this complex world and helping to get the client on the right path to do the right thing, even though their temptation in the back of their mind is to do what feels comfortable. It's sometimes the uncomfortable thing, which is the right thing to do. So I think the future of advice is really exciting because I think we're living in a changing world. Advisors who embrace change like you do will flourish in an environment like this. Advisors who hesitate to adopt or resist adoption altogether, they go the way of the dinosaur. And I think that's kind of where we are as an industry. We're moving at a very rapid rate, and you're either adopting and moving forward, or you risk being left behind.
In that, You actually teed up the follow-up question I had. And so a little backstory. I went to the Berkshire Hathaway conference this year for the second time. There's a caveat to that because I didn't make it to the Saturday because I got violent food poisoning the night before. So I booked it. Yeah. If you ever send me a turkey sandwich, I'll probably punch you in the face. So that is just out in the open. But before I was violently vomiting up my childhood memories, I had a really good lunch with, and that was not the lunch that took me down, Robert Hagstrom, who's wrote The Warren Buffett Way, has become a good buddy. Only guest to come on the show twice. For whatever reason, he wanted to come back and talk to me again, which means he didn't have anything going on in his life. But I digress. And I was talking to him about how a lot of these advisors, they're not actually advising and they're not actually planning. They're hiding behind the letters to be glorified wholesalers. And he brought something up and he says, Chris, you know what? You're not actually talking about financial advice or financial planning. You're referring to what you are doing, which is financial philosophy. I thought, whoa, that is super cool. And so my question is, do you think the financial philosophy will start to catch on, or do you think the majority of advisors are going to lean on the jargon, beta, allocation, continue to remain lazy?
I think you've captured it. So I'm no plug here, but
thank you.
Yeah, I think what you're focused on is wealth planning. It's all aspects of wealth planning. Meyer Statman just wrote a book that he came out with, and he talks about a lot of these things beyond the financial planning aspect of it. And I think that's the way that you're approaching it. And I think a lot of advisors are starting to figure that out. It's really holistic planning, every aspect of a client's life, because they're all intertwined, right? We can't separate the financial. Not everyone's going to be on that journey, but I do think that is the future, really thinking about how we tie all of this together. You know, when I think about allocating capital investing, it's the ends to the means, right? Can this help fulfill my dreams, goals, and aspiration? Can I achieve enough wealth so I can leave a legacy for my children? You know, things that you talk about in your book. I think those are the things that we need to really think about, is like, how do we allocate capital to have better outcomes so we can live the life that we want to? Rather than falling into the trap of, cookie cutter, dogmatic sort of solutions. I like the idea of personalizing. I like the idea of really understanding where clients are and ultimately what they're trying to solve for. And I like the idea of, to the extent we can, making it as easy to understand as possible, although I think you and I need to recognize that we live in a fairly complex world. So as much as we try to make it simpler, it still may be something that feels a little uncomfortable to some investors.
Yes. Like my buddy Gautam Bade has always said, it is simple but not easy. And my last question, actually, before we close this thing out, if unless you're just living under a rock and you were just ignoring the entire episode, it's safe to say that you and I both believe that alternatives are here to stay, and people are adopting more alternatives in our industry. And it was interesting, though, because you start to ask planners. I had this conversation with a buddy of mine a couple weeks ago, and love him to death, lifelong friend. And he was saying that, yeah, I use alternatives. Like, okay, what's your strategy around private equity? Like, what's your philosophy? And he's like, oh, I got one fund. I go, oh, okay. Well, what about real? Yeah, one fund. Private credit, one fund, maybe. And I'm thinking, oh, that's not using alternatives. You're just gunslinging a wholesaling product. I mean, that's what you are. So my question to you is, do you truly believe that holistic approach or approaches to alternatives will become mainstream? Or do you think that it's going to be a while until we get to that point? And until then, you've got people that claim to be true planners in advising with alternatives as well as traditional markets. But then when it comes down to it, everyone has the same REIT, private equity, and private credit fund.
I'm going to ask it. I'll answer it maybe a little differently than you asked it. And that is that I believe alternatives are moving toward becoming more mainstream. And I'm going to focus more on private markets because I don't hear a lot of people asking about hedge fund strategies, but I think private markets are on their way of becoming more mainstream.
I agree.
But I'm going to recognize what you're talking about, which is that not everyone's value proposition is their investment acumen. Some are more relationship people, some aren't really strong on the investment side. So I think the industry will respond, and the industry is starting to respond, but will respond in a more meaningful fashion of providing model portfolios, which will make it easier, right? I don't know what my right percentage could be, so at least I'll provide a marker up there that will suggest you should have 10% private equity and 7% private real estate and 3% private credit, and here's why. That will help along that journey. I also think we're going to start to see, and this is something I wrote about in my book, and the last 3 chapters of my book are really kind of anticipate where we will be as an industry. I think we're going to start to see more completion portfolios, which are public-private portfolios. So for that advisor who maybe his skill set isn't conducive, or maybe he doesn't have experience dealing with some of these complex strategies, we're going to start to see solutions that actually wrap all those strategies together, which will make it easier so we get a more consistent experience across the spectrum. I think those would be good things. So I think the industry will adopt to understand that not all advisors use the tools the same way, but all should recognize the value of it. So I think as an industry, we will evolve, but we are in the very early stages of this industry adoption of private markets across the wealth channel. And again, I think over the next 10 years, it's going to be a really exciting time as more and better products come to the market, maybe for folks like you, more granular sort of sleeves, so you could be very precise in getting your exposure. And maybe for those who feel daunted by allocating to these complex investments and not really having the ability to see through and understand what's going on, making a singular decision, which then an expert is making those decisions for you. So I think as an industry, we're early, but we're evolving very, very rapidly as there's so much demand for private markets across the wealth channel.
Yeah, I could not agree more. Well, Tony, thank you so much for coming on the show, and we look forward to maybe having you again. Most people once they're on, we've only had one second timer in Hagstrom, but you could break that glass ceiling and come back at any time.
Well, it's always a pleasure having a conversation with you, and if you would have me back, I think it'd be a lot of fun.
Yes,
thank you.
See you, buddy. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Chris Panayiotou, Certified Financial Planning Professional, the Cap and Capitalize. And until next time, keep capitalizing.
Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. The economic forecast set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. All investments involve risk, including potential loss of principal. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. An asset allocation strategy does not ensure a profit or protect against loss. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. Alternative investments may not be suitable for all investors and should be considered as an investment for the risk capital portion of the investor's portfolio. The strategies employed in the management of alternative investments may accelerate the velocity of potential losses. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. You should carefully consider the investment objectives, risks, charges, and expenses of a non-traded REIT before investing. The prospectus, which contains this and other important information, can be obtained from your financial advisor. You should read it carefully before investing or sending money. Before investing, carefully consider mutual funds or exchange-traded funds investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Structured products are considered complex investment products. They contain unique features, risks, terms, conditions, fees, charges, and expenses. CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. Christopher Paniotu is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. Tony Davidow and any other individual or company mentioned in this podcast are not affiliated with Capitalize Your Finances or LPL Financial.